So, if you guys have been around in the financial space long enough, you probably will come across the term hedging or to hedge. Now, what if I tell you that hedging can be implemented in your mining strategy? Now, I already made a calculator for it, and so let's talk about this in this video. Hello guys, welcome back to the channel. So in this video, we will be talking about hedging and how to incorporate it into our mining strategy. Now, first of all, I need to tell you guys about the definition of hedging. In finance, to hedge means to take an offsetting position in an asset or investment that reduces the price risk of an existing position. Basically, a hedge consists of taking the opposite position in related security or in a derivative security based on the asset to be hedged. Now, our asset to be hedged are our mining yield or our mining profit, mining results, and we need to take a hedge against that mining profit or sorry, mining yield. So let's get on to the calculator. Now, let's talk about the calculator first. So this calculator is, I have need to say disclaimer, this is not perfect because as I said, this is just I created on my own and I haven't peer reviewed it. So please, if you guys download this, then you can also help me peer review it, or you just have for fun and mess around with the code, right? Also, you will always earn or lose more money without hedging. This calculator is made with the intention of trading and acting as a hedge fund. This specific sheet, okay? So not a business trying to hedge their risk. So if you are a mining business or you're mining personally, you should use the mining hedge strat or the option hedge strat sheets. So this calculator is by no means perfect and not financial advice. Use it on your own risk. Now, I won't stay a lot long in this sheet because I do believe that people are quite intuitive with this sheet. Basically, you just hedge against your position depending on how many risk you want to take. And this is much more trading focus. And since we are miners, we are more focused on the how producers such as us hedge our risk to the downside. So as producers, if you guys don't know, we are always long, right? Because we produce our goods and at some point we need to sell. So obviously we are basically in a long position. Now, how to hedge that is we take the counter position, basically to short the market. Now, there are two options if you want to short the market, either using a future contract or using an option, a put options. Now, in this first sheet, we will be talking about shorting. So, shorting using a futures. You can use whatever futures there is. You can use Binance futures, perpetual, or you can use any other exchange futures that provide you. Now, I don't know about in the US there is additional regulation or not, but at least in the other countries, you are usually able to uh, trade futures reasonably well as long as you pass the knowledge test that the exchange give to you. Now, other than that, you can use DeFi also. There are many dApps, futures trading dApps and you can just search it in DeFi Llama. Now, anyways, let's talk about the calculator and how do you use it. So every single green bar here, you change. Okay, so basically you need to change the green bar. Actually, you don't need to change this because basically you just enter here and this will automatically update. So I should have used it transparent. Okay, so let's talk about the calculator. Expected coin mined per month. So make sure that you know that your expected coin mined. You can use BTC or E or XRP. You can just search in the drop down menu below, right? Basically, the price is located here, okay, in this sheet, crypto price. So if you don't find your favorite cryptos, you can just type in the ticker name. I don't know ticker name you want to search. Maybe let's see what I don't have. Okay, maybe you want Caspa. Okay, Caspa, KIX. You just use the copy or drag down, and you can get the price. Okay, so because I don't have Caspa, and you can add your crypto as long as the price is available in cryptoprices.cc. Then, and they use CoinGecko, I think. So basically, as long as your coin is on CoinGecko, you can get the price. So whatever the token is, maybe Toko Crypto, right? TKO, you can use it also, right? Now, let's get back to the calculator. So your expected coins per month is, let's say, BTC, right? You mine BTC. Let's go for the S19J Pro 104, since I think that most people have this miner. Okay, let's calculate. This is per day, 0.000362. And you times it by 30, because I think that a month is average out at 30. 0.01086, right? You can copy this and you plug it in like that. Then, as you can see, you need to have initial investment. What do I mean by that? Okay, so before the month starts, you need to have this amount of money in your trading balance. So basically, before you mine any single coin for that month, you need to have this money, either from your own pocket or your previous month's profit. Okay, so the first step, sell your initial investment at the start of the month. So at the start of the month, let's say February, okay, because today is January, I think, 24 January. So in February, the 1st of February, you sell your investment. Let's say the price is this amount, right? I mean, this is the price right now, but I just use it as a reference price. So you short this amount of BTC, you short the same amount as you are expected to mine for that month, and you need to pay around $249 at the current price of BTC. Okay, you need to pay that. So you need to have $250 worth of, I don't know, USDT or something, or other stable coins, or you have 0.01 BTC to short that in the future market, right? You can use Binance, you can use any other exchange. So I think that people are quite familiar with shorting in the future. So I don't think I will go in depth with it. And there are a lot of tutorials in YouTube, depending on your platform. Now, the second step is at the end of the month, sell your mine coins and close your future position. Now, let's say the price of the month is 22,000. So you sell the mine coins 0.010089 to get a value of $238. Then you close your future position, and because this price is lower than your entry price, so you get a profit of $10, $10.66. So the overall cash received, if you are hedging, is $249.58. If you don't hedge, or basically you don't do this one, you don't short, you will have $238.92 only. So the benefit of hedging is $10.66. Now, what if the price of the asset of BTC decrease further, right, at the end of the month? So it's not 22,000, it's maybe, I don't know, 16,000, let's say 16,000. Okay, so you sell at a significantly lower value at $173.76, but you see your future position profit increases to $75.82. Thus, your overall cash received is the same, right? Or almost the same at $249.58. If you don't hedge, it's $173. that means that the benefit of hedging means $75, right? That is your basically your profit. Now, how about the other way around, right? Let's say the price increase so to 24,000. Okay, so the 24,000, the value of your sell price is $260, so increasing than the previous, but your futures, your short futures have a loss of $11 because the price increases. So if you don't know, short means you expect the price to decrease to profit, right? So the overall cash received is $249.58. With no hedging, it's $260. Thus, the benefit of hedging is negative $11. So you lose money compared to not hedging. Okay. Well, how about if let's say 30,000? Okay, the same. The overall cash received is the same. How about I don't know 100,000? See, the same. So the benefit of this hedging means that no matter how much the price moves, you will receive the same amount of cash at the end of the month. So no matter if it's 100,000, if it's 1,000, you will receive the same amount of cash no matter what. Okay, no matter what. So this is the beauty of it because if you are feeling that the volatility is too high, or you know you feel that the downside is very high compared to the upside, then I think I recommend you use hedging because let's see if we think that 23,000 because the recent crypto pop is not sustainable for one way or the other, and you said okay, perhaps in the next months or so, the price of Bitcoin will decrease right to 22,000. Then you save about $10 of profit. Then you don't hedge, right? You don't hedge. Now, what if the price get lower than that? Maybe a crash somehow. Maybe the Fed, for some reason, increase the rate to 50 basis points, which is basically not what market predicted. So let's say it crashed to 18K. See, you still receive $249. So this strategy is best for you if the price of Bitcoin is going down or in the bearish trend. Now, as we are in the bear market, so, and probably the next bull market will start in 2024. I think hedging needs to be on your radar, right? Or on your back of your mind as a sort of strategy that you can use in case of bearish trend that you see, and to protect your position also. Now, do note though, this only works if you want to sell your coins, right? This doesn't really matter for you guys who hodl your coins, but I can if you are one of those hodlers, then just use this as an information, right? And not like a strategy that you need to follow, but just information that hedging works for mining. But the disadvantage of future hedging is that you need initial investment that is quite high in comparison, right? You need $249 in the front to do this hedging. Now, this is fine if you say you have one machine, but how about if you have like in the month you mine one Bitcoin? Right, you need to prepare $22,000, and I don't think that you have $22,000 lying around. So obviously, this is quite expensive. Now, how do we, change the expensiveness of this? Maybe we could use options. So, an option is a financial instrument that is based on the value of underlying securities such as stocks, cryptocurrency, etc. And it offers the buyer the opportunity to buy or sell depending on the type of contract they hold, either a put or a call option of the underlying assets. And unlike futures, the holder is not required to buy or sell the asset if they decided to against it. That's the name options, right? Each options contract will have a specific expiring date by which the holder must exercise their option. The stated price of an option is known as the strike price. Options are typically bought and sold through online and retail brokers, right? This is based on Investomedia's definition. So let's talk about the calculator of options. Now let's have the same example as the futures, which is at this one, right? This amount. So let's copy this and paste this. So we have, okay, so let me change this to green again. So we have a 0.01 BTC per month, and let's buy a put options at the start of the month. The put option size is the same at 0.01 BTC. So you can, for put options in cryptocurrency, you can, you don't need to buy 100 shares of BTC or something. You can buy a fraction of BTC, and the strike price, choose the strike price that is closest to the price currently. So the strike price is 23,000. So make sure to have the closest strike price as possible to the current price. So the current price is 22,982. So you need to have the most closest, which is at 23,000. And it expires in 30 days, but I think that Binance doesn't have 30 days expiry put options. So let's see. It's the longest is 27 days, 14 hours. So we need to use that. So 27 days. It doesn't really matter. This is just for information purposes. So option price, okay? Option price. You need to see in the Binance or whatever option platform that you use. 23,000 put options. The mark price is 1,261. 1,261. It's quite expensive because this put option is in the money, right? Or basically, it has some intrinsic value. So the option premium is calculated by multiplying this option price times your option size. So basically, these are the amount that you pay to buy the options, or basically the price to buy 0.01 contract of BTC, right? So basically, this is the premium, or that's the options terminology. Now, at the end of the month, your put option size is still the same, obviously, and the strike price is still the same. But let's say the current index price or the current price of Bitcoin at that time is $20,000. So it has decreased $3,000. Then currently, so the options price is $3,000 because the option price is almost has no extrinsic value anymore. So all of it is just intrinsic value, or basically how in the money the option is. Thus, the price approximately is around $3,000. Basically, this the delta or the difference between the strike price and the current index price. Now, option premium is still the same, so you just need to times the option price times the option size, and you get the option premium. Now you can see that the option premium has increases. That means that if you sell this option, or you exercise it, whatever, the PNL option with options is $18 profit, right? $18.89 profit. The sale is $217.2. So the sale means that you sell your mine coins at the end of the day, and your money is $236. You get at the end of the month. So with the additional investment of $30 or $14, right? Basically, this is $14. You can hedge your position and get an $18 option, and you can have about if no hedge, the price is $20,000. The sale is $217, and you have a profit of 8%. So if you hedge using this strategy, and the outcome is $20,000, then you will have an 8% advantage compared to if you don't hedge it. Now, what if, let's say, we decrease the price, right? What say the index price have catastrophic decrease, so maybe 18,000, right? 18,000. Okay, let's see. Okay, so the option price is now $5,000 because the intrinsic value, the difference between this is $5,000, and the option premium has $54. Now, so the your sale money obviously decreased because you sell at a lower price compared to before, but your options increase in value. Thus, the amount of money you have is the same, right? If we go back to $20,000, 23. Remember this number, okay? 23. Remember this number. See, no difference. No difference, right? This means that no matter how low the price is, how low the price gets, your money that you receive will still be the same at $236. Now, if you don't know how put options work, there is a certain period where there is a certain period where they ramped up in profit. So let's say $22,000. Okay, $22,000. The PNL options is minus $2. Now the reason why it's minus, even though they have decrease in $1,000, is because you pay the premium in the first place. So basically, the put options profited to $10, but because you have an initial premium of $13, you lost about $2. So it's a bit of a different, right? Let's say $20,000. See, it's still the same, but you have a negative here. And if you don't hedge, you actually better off than if you hedge, right? So about minus 1.2% loss compared if you just do it normally, just sell it. So let's talk about if let's say the price goes sideways and don't do anything. Okay, so we lose our premium as normal because the option price just is worthless. It's zero. So and the option premium is obviously zero. Now if you don't know why, it's just because that is how the option price works. And if the price is the same as the strike price or higher than the strike price of a put options, it is worthless. It expires worthless. And yeah, so the PNL, we lose every single dollar of our premium, but our sale is $249 bigger than previous examples, and our money that we get is still the same at $236. Now, if we don't hedge, we have a PNL of additional 5.8%. So basically you are much more profitable if you don't hedge. Let's say we increase the price, right? Let's say the price of Bitcoin increases. Okay, so our options still have the same amount of loss at our premium, and our sale is higher, so thus our money we get is higher, and the PNL hedge against no hedge is still around, hovering around the same. Let's have an extreme example, maybe $30,000. Okay, so have you seen how the PNL between hedge and no hedge is decreasing? So and basically the same amount, no matter how high the price of the at the end of the month goes, maybe like 100,000, the options will still stay the same. The option loss will still stay the same because your maximum loss is the loss of your premium. Thus, this is actually one of the best hedging strategies if you don't want to lose much money, or you don't want to have a lot of initial investment, right? If the price go down, your amount of money that you get will stay the same. So at $22,000 will be 236. At $18,000 will have 236. At $11,000 you will have 236. But this hedging strategy doesn't impede your future your profit if, let's say, the price of Bitcoin increases, right? Because let's say, as I said before, 25,000, it only decrease your profit by 5%, right? And it's not really that big of a deal. Maybe if, let's say, 30,000, see, it's only decreasing your profit by 4%, so it's not a really a big deal. So this is it. It has limited risk, but you have very good profit either way, right? Thus, I think that this option hedging strategy is the best. Now, obviously, this is using Binance options, and you need to have it expires, or basically you need to exercise it, or you can also sell it at some point, depending on, or you close your option position. So it doesn't really matter. Now, if you use any other options trading of cryptocurrency, I'm not sure how they work. So obviously you need to research it on your own. Now, so if you find this video helpful, then click like and subscribe. And also, this Excel sheet or this Google sheet is available on my Discord channel. So you just go there and download the Excel. So first of all, after you have downloaded, you just go to your sheets and upload it, right? You go to your sheets and upload the XLX file, and just edit it from Google Sheets. The reason why you need to use Google Sheets and not Excel is because the crypto price will not work in Excel. This formula is only work for Google Sheets, right? If you don't want to use Google Sheet, then you need to change this formula into something that the Excel recognize. Anyways, that's all for this video. I'll see you guys next time. Bye bye.